invested 900 of preference capital. Total capital is 1000. So, do I hold one half of the total capital? No. But I have 100% of the equity. Now the person who's holding preference capital holds 90% of the total capital. It becomes a subsidiary of that company. How do you consolidate? In accounting standards, that is part of minority interest. There is no, the whole thing is minority interest because there's zero equity. That company of which it becomes the holding company has zero equity. So we said, how can you have a situation where a company is a subsidiary company under the Companies Act, but not a subsidiary in accounting standards? This is violence. Now when we get on to IFRS and we get to IFRS 10, we could have an even more wider definition of subsidiary there. Because there it's being in a position to control. Even if you have 30%, there are situations where it can become a subsidiary. So all we are saying is change this. So what did they finally do? They said only convertible preference share is to be included for the purpose of total capital. Still it doesn't change the situation. It still is the same problem. And this is core. So we are still at a loss today when you deal with provisions related to accounts. Do you consolidate subsidiaries under the Companies Act or do you consolidate subsidiaries as per accounting standards? The same rules say you shall comply with the accounting standards for consolidation. Right? Then how do I do that? That means in my accounting standards I will have 10 subsidiaries. In the Companies Act I may have 12 subsidiaries or vice versa. And then in the board report I am supposed to discuss the performance of every subsidiary. Which subsidiary? Those which are consolidated or those which are part of the Companies Act. So that ambiguity is still trying to take up, but I am not sure. But the ministry kept saying you have done it on purpose. Now what do you do? They say we have done it on purpose, you stop. They further have said that we have told the Institute of Chartered Accountants of India to amend the accounting standard. Now you amend the accounting standard, nowhere aligned with anywhere in the world, this sort of definition. We'll have to wait and see how it is. And in some cases they will say subsidiary includes associate or joint venture, which is again ridiculous. Subsidiary cannot include associates. We'll come to when we come into the subject of consolidation. Books of accounts, I won't get into this. I need to manage time carefully. There is a lot on books of account, and you see how in the rules they have gone, and in the law. There shall be a proper system for storage, retrieval, display, printout of electronic records. Okay. Manner of disposal. Backup of books of records and other books of paper maintained in electronic mode shall be kept in servers physically located in India. So you can't have a server outside India. But more importantly, what they have done is this particular. The books of accounts and relevant books and papers, this is in the law, shall be retained completely in the format in which they were originally generated, sent or received, or in a format which presents accurately the information generated, sent or received contained in the electronic record shall remain complete and unaltered. Effectively it means, let's take your tally of you have to maintain for 8 years. That means you have to not only maintain the record, you have to maintain the software or related to that year. It may not necessarily, and you have migrated from say a tally to an ERP system, then you will still have to maintain that tally platform somewhere because this record shall remain complete and unaltered and you shall do that. So I don't know what mindset they've had in terms of preparation or maintenance of records in electronic form. So if I have even Windows of a different version, older versions, do I need to keep the earlier versions of software and earlier version of accounts? I'm not sure how it is, what the intent is. And you have to keep this for a large number of years, so that is a challenge. So these are some innocuous things. You should keep it to not just the name here. Okay. Now come to depreciation. Core governance, Schedule 3. What it says is, you shall, okay, now Schedule 3 is your Schedule 6, I'm sorry, I'm not on depreciation now. You've been through this, I think, as a separate topic, I suppose, so I will skip this particular. Let's come to depreciation. Depreciation has changed from rate now to useful life. If you see Schedule 2 to the Companies Act, it gives a list of assets and it gives useful life. The intent, if you see, this one schedule or its equivalent was finalized years ago actually. It was finalized when we were about to move to IFRS, that is Ind AS, and that we were supposed to move 1st April 2011. So around 2010 this was finalized, this whole schedule almost. Because IFRS required you to provide depreciation over the useful life. You are free to determine what is your useful life of the asset. Provide depreciation over the useful life minus the residual value, original cost minus the residual value. That was the requirement. Now, in this schedule 2, they have provided 2 categories. For they said for certain class of companies, you are free to provide determine the useful life. For other class of companies, your useful life shall not be greater than useful life indicated. That means you cannot have a depreciation lower than. So if you see the schedule, they have said for a certain category, let's say useful life is 10 years. They said this 10 years is on single shift basis. 10 years, original cost is 100. You cannot have residual value greater than 5%. You can have residual value 0. 10 years, 100 rupees, 100 divided by 10 is 10%. So that's how you are able to break. Now the killer is the transition provision. What does the transition provision say? The transition provision, I'll show you. It says that now the useful life is 10 years. If your asset, if in the past you are providing depreciation at let's say 5%. Now 10 years is working out to 10%. You will have to take 10 years as a life. If you have depreciated 3 years already, now your life of the asset remaining is 7 years. So you have provided 3 years depreciation at 5%. So 5 plus 5 plus 5, let's say straight line for simplicity. You have provided 15. Your net book value is 85. You divide 85 by 7. You will get 12.8 or something to that. No, you will get a little more than that. You will get close to, you will get around 13 years of depreciation or more. Now, you will have one asset at 13, another asset at 12 point something, third asset at 11 point, some new assets at 10% rate of depreciation. That requires arithmetic, it requires tweaking of your computer systems. You have to determine what is the life. Now there is one more confusion I'll come to. Before that, they have prescribed rates for each of these. Industry-wise rates also they have given. It also says that componentization is introduced. If a particular component of an asset has a useful life different from the rest of the asset, that component shall be depreciated differently, which is the principle in IFRS, which is there actually in our Indian standards but never applied to that rigor. So separate capitalization and depreciation for part of an asset if its cost is significant to the total cost. Will this be allowed by income tax? Is a debate. But this is a principle which is set in schedule to the company tax. And if you use a useful life which is different, then you should indicate. The way, this is again by way of a notification has come, but the notification is badly worded. Again, you have taken, I mentioned to the institute yesterday too, and I'll explain that to you. But look at the impact first. Take this case of office equipment. The Companies Act 2013 prescribes a useful life of 5%, 5 years. That means the rate comes to 19%. The Companies Act 1956 had a rate of 4.75%. So there is an increase of 300% in the rates already for this year. And electric installations, useful life is 10 years. Earlier that translates to 9.5%, assuming 5 is the residual value. Increase of 100% increase in rates. Now, this will impact everyone. And as I said, there is this transition provision which is here, which says the carrying value shall be depreciated over the remaining revised useful life. And if you are suddenly, let's go down to this, office equipment 5 years old. You bought something which is 6 years ago. You would have depreciated it at 4.75%. Right? That means your you would have at least 70% of the value will still be remaining, because you would have provided depreciation of around close to 30%, 4.75% into 6 years. Now the useful life is 5 years. So what do? So the useful life theoretically is over under the new Companies Act. The entire amount you have to charge it off against reserves, opening reserves. The other way is 4 years are over. You have provided 4 into 4.75, right? Which is 19%. You have provided 81% of the asset is remaining. 1 year only is left. That means in this year you have to charge off the entire 81% to the P&L account. That is the extreme impact of this change. Now this doesn't make any distinction of public, private, big, small, everybody. It impacts. And this is a huge issue. Maybe understated, but this will impact the results of companies. Now, the way the notification was there, the notification, if you see the draft, the text of the notification, the intent was, as I said, there were 2 categories of companies. One where they were free to use the useful life, in another where the useful life cannot be greater. That means you cannot, that's the minimum depreciation. Now we don't know when IFRS will come in, at least officially. So, the ministry sent out a notification saying useful life shall not be greater than what is given in this. But they say provided if the useful life is different, you shall disclose. You are free to do and disclose. What does different mean? Some people have interpreted it to say you cannot have the useful life greater, but you can have it lower than that. And if it's lower, only you disclose. Which I don't think was the intent. The intent was to allow you to have whatever useful life you think is appropriate, and these are only indicative useful lives. You determine what is useful life and appropriately provide. And if you really see this, you may argue desktop is the useful life 3 years. In many situations, the contract itself, there are warranty obligations for 4 years. You cannot have useful life of 3 years if the warranty is for 4 years. So that logically means that the manufacturer himself believes that it will last for 4 years, at least a minimum. So I'm just giving you some illustrations. There are some servers for 6 years, so it could vary. Accounting standard. What section 133 says, that's been notified. It says accounting standard shall be that which is prescribed by, recommended by ICR, and of course notified in consultation with NFR. NFRA is not yet formed. So right now they said earlier accounting standards notified by ACAS will continue. That is the transitional provision as of now. Financial statements, you shall comply with accounting standards. You shall provide that it shall be in the format of Schedule 3. You have discussed no new, the provisions are not new here except consolidation requirement. Where it says, where a company has 1 or more subsidiaries, it shall prepare consolidated financial statements. The killer is, subsidiary shall include associate and joint venture. Correct? So effectively what was happening in the past, you had a company, you did not have subsidiary. You had an investment in another company of 22%. That was an associate. You have not required to consolidate because you did not have subsidiaries. Now it says subsidiary includes associate. So even if you don't have subsidiaries, you have to consolidate and include that associate as a one-line item in the profit and loss account as profit from associate or loss from associate, which is bizarre. There's really no need for that. Second issue is, it prescribes consolidation for every company which has an associate or a subsidiary. Effectively, it means that if you have a parent company, you have one layer of subsidiary. You are a listed parent company, you have a subsidiary, unlisted. That in turn has another subsidiary, unlisted. That in turn has another subsidiary, unlisted. Every level you have to prepare consolidated financial statements. Fine, there is no exemption. Whereas in the accounting standards, in the international accounting standards, there was an exemption that if the parent company produces consolidated financial statements, intermediary companies need not prepare consolidated. So you look at your own companies, public, private, everybody, you will find that even if you have an associate, you have to not only produce standalone, you have to do consolidated. One can look at this an opportunity in terms of auditing too, but that's a different subject of it. These are the old provisions about not complying with accounting standards. You make a disclosure, there's nothing. The contravention, if you don't comply, managing director, all-time director, CFO, everybody shall be punishable with imprisonment for 1 year or with fine. Okay, this is a very common thing, which is imprisonment, fine is very common under the new act. Okay. Then there are a whole host of financial statements I won't get into. Revision. For the first time, there are provisions related to revising financial statements. In the old law, there was no scope for revising financial statements. Even when Satyam happened, we had the challenge of a 5,000 plus crore hole in the balance sheet. You know the results of the past periods were fraudulent. Do you go back and revise each of the years, or do you adjust everything in the current? The then law did not allow us to go back and revise. So everything had to be charged off in that particular year as a exceptional item. The same company was listed in the United States. US law required you to revise. It was physically impossible. I know there is a fraud. The whole is 5,000 crores. Which year it related to is very difficult to identify, not easy. But I know currently that that much cash is not there, or deposits is not there, this problem. So they finally delisted from the US. They said we can't do it. US said we won't give you exemption from the restatement. So they delisted from the US. And therefore, that's where they got around. The current law has two provisions. Mandatory revision of financial statements, which is a dangerous one, and a voluntary revision of financial statements, which also has its challenges. Now, the mandatory is covered by section 130. It says a company can reopen its books and recast if its accounts were prepared in a fraudulent manner on application by central government, IT authority, SEBI or any regulatory body. Now, as you know, SEBI has constituted a committee to look at qualified audit reports. For SEBI, that committee will slowly look at all audits, all the reports. And SEBI has found that in many cases, the auditor's qualification is justified. SEBI has, through exchanges, now started writing to companies saying you revise your financials. SEBI's view is that it can't mandate revision of financials under the Companies Act, but at least its published results for quarterly reporting has to be revised. But this is an extension of that. You could find that the tax authorities may disagree with something. SEBI may disagree with something. Force you to revise your earlier financial statements. In India, we may be comfortable, but outside India, if you do any revision, you will be sued. Anybody, the moment you revise a financial statement, investors will sue you. Because if your profits are better in the revised financial statements, he says, had I known this was the profit, I wouldn't have sold my share. I sold it and lost money. If your profit is now worse than what it is, he says, had I known it was so bad, I wouldn't have bought the share. So anyway, somebody will sue. Class action suit is guaranteed. And now we have section 245 in the Companies Act, which allows class action suits, which even lawyers are terrified, tax advisors are terrified. This is a completely different section. Then there is section 131, which is not notified though. It deals with why are these not notified? These sections will get, because it deals with National Company Law Tribunal. NCLT is not notified, so what will you do? Whose permission will you do? So, says, if you could volunteer, if your directors believe that your previous financial statements are fraudulently prepared, then you can yourself voluntarily revise. This happens when there is a promoter fight or some foreign party has come in. He will say previous financials are wrong and it gives scope, but then this requires permission. So there are challenges in this. Board's report, section 144. There are disclosure requirements, is not so much accounting, but let's come to what it has to say so far as auditor. They will give explanation or comments by the board on every qualification, reservation or adverse remark by the auditor, not you. Okay. But let's get on to, more importantly, let me get into details in respect of adequacy of financial controls. That is another reporting on internal financial controls. This is the one. Directors in the case of a listed company laid down internal financial controls to be followed by the company, and such internal financial controls are adequate and followed effectively. Internal financial controls definition there included controls efficiency, which I think you see the definition. Policies and procedures are out to the company for ensuring orderly and efficient conduct of business. Directors have to confirm that, and auditors have to report on which is the problem. The entire international landscape requires auditors to report on internal controls over financial report. Not every control which relates to operating the business efficiently. That has got nothing to do. Now if you see the provisions, auditors of public and private companies have to report on internal financial controls. And this is the definition of internal financial controls, which has this very wide provision of orderly and efficient conduct of business. And you not only, in the past if you see, auditors were expected to report whether controls were adequate. Now it's operating effectiveness also they have to comment on, not just whether you have adequate controls. That their operating effectiveness. That is a challenge which is coming up. Guidance is coming up from the Institute of Chartered Accountants. We don't know whether that guidance will be in accordance with the COSO framework or the Canadian Institute or the English Institute. And what is the rigor which is required, but that's a big issue, subject matter. Now let me come to the provisions related to audit and auditors. This is the core. If you see just this slide, you have on the top of the auditor or the profession a new body called the National Financial Reporting Authority. So first is the entire profession itself they have in a way taken over by or proposed to take over by a body called the National Financial Reporting Authority. I'll show you that body sets accounting standards, monitors and enforces compliance with accounting standards, sets auditing standards, monitors and enforces compliance with auditing standards, enforces quality, inspects audit firms, investigates, punishes. So what it does not do, conduct examination, it does not conduct seminars and conferences, and it does not get into disciplinary cases of non-corporate. But this is a sweeping power, so there is a concern. There is a concern, or today the company may say that we will cover companies of a certain size or auditors of a certain size. But the principle here is that the profession cannot regulate itself. Or the days of profession self-regulating seems under this law coming to an end. I vividly remember 1986 in Mumbai, somewhere in Juhu side was All India Conference. Ani Palkiwala was addressing the conference. Now Palkiwala was a brilliant legal person. He was a keynote speaker in the conference. I had come in from Eastern India, a relatively younger person. Palkiwala said, I admire your profession. He says, the question is who shaves the barber? He says, you guys have done so well. My legal profession hasn't done it so well. You're great in being able to regulate your profession. So that was 1986. Today in 2013 Act, this is what we have. National Financial Reporting Authority. That is the reality. If this authority is created and has substance, I can tell you there is no equal across the world. There's in no place in the world is standard setting of accounting, auditing, enforcement, investigation, inspection of firms, punishment, all under one body. There are no country. There are variations, but in no country is. Then you have provisions relating to appointment, which also impact eligibility or disqualification because of a relative, which again shakes the whole profession, makes it compliance difficult. Auditors' powers, okay, the powers may be more in terms of your access to subsidiaries, that's also important. Scope of services is another huge issue in terms of the way it is drafted, which has changed. Reporting requirements are so onerous, they will insert some clauses which are difficult, and penalties for extreme. So in effect, what they have done, they have affected your professional body. They have changed the profile of your practice as to what you can do, whom you can serve, for what period you can serve, and how it is. You will not have the client for perpetuity. They have changed your profile of your practice in terms of what services you can render to your own client, what you cannot. They have changed your independence rules in terms of making you not independent and being disqualified as an auditor based on certain criteria. They have enhanced your punishment significantly. They have enhanced your reporting obligations dramatically. First, they enhanced your reporting obligations dramatically, and finally, they have enhanced your punishment dramatically, including punishing the firm instead of the member alone. So this, what is left? There is nothing which is left insofar as the provisions relating to auditors or the CA profession, which has not been tampered with or touched, and which will dramatically, it's not an issue of big or small, it affects everyone. Because even if you are a two-partner, three-partner, somebody has done a mistake or perceived mistake, the entire firm will be punished. There will be serious issues. My problem today in India is never the law. It is the quality of administration of the law which is the problem. Outside of India, you get justice which is swift, fair, and certain. In India, the case starts against you, it takes 20 years. You die. Today, Sanjay Dutt is sent to jail for 1993 offense. Right, wrong is not the issue. The issue is sent in 2013 or whatever. So imagine, only when you are facing it, you realize how slow the process is. Somebody, an ROC, will write a report, whatever it is, and there is a case filed. That's it. That case will remain. And because there is a pending case, you will not be appointed as an auditor. Banks will not appoint you. Because the Reserve Bank will ask any pending cases. Insurance companies won't appoint you, they will ask. Now Companies Act for appointment auditors mandates audit committees to ask what are the pending proceedings. Now when they see, they may not appoint. Oh, there is a criminal case pending against us. I have seen criminal cases filed nearly on very, very flimsy items of disclosure of the financial statements, on none, which has happened every time there is a failure by a company to repay a bank loan. The banker complains to CBI, nationalized banks, they wash their hands, they give the case to CBI. CBI will call the promoter says, yeah, I diverted funds, I'm sorry. So when he has diverted funds, they say their financial statements are fraudulent. So the poor auditor proceedings start. It doesn't go on forever. That is the concern. So the concern is the manner in which the law is executed. That is why I really fear of this. That when there are provisions, I should be able to comply. Second is, why do you proceed in writing a law believing that everybody is a thief? Don't shoot an ant with a cannon. You have to kill an ant, focus on killing the ant, and the group cause collateral damage. So in the process, they have caused a lot of collateral damage, which is where the profession is not. And I can tell you, the profession is yet to grasp the magnitude of this. And it will go down to that remote ROC who will actually be doing the inspection. And when he does it, you will find that his job is to find something. And then it gets on to the whole process. Now NFRA, first, it formulates accounting standards, enforces compliance with accounting and auditing standards, formulates auditing standards, oversees the quality of the professions, investigates, and wherever it takes up any matter, ICI cannot take up that. That also is provided in the law. And of course, there is a whole appeal process. We'll have to wait and see as to how this will. The rules prescribe saying it will not cover certain companies or it will cover companies above certain size. But those are draft rules. That can change depending on how the body is framed and what it is. But the real issue is that this body, if it is formed, it means a life different for all of us. That's all I'm trying to say. And earlier it was only auditing standards, now conceptually it is so different. Let's take appointment.